August 29, 1842. HMS Cornwallis sits anchored in the Yangtze River, its cannon trained on the walls of Nanjing. Inside the ship's oak-paneled cabin, three Qing dynasty officials, Qiying, Yilibu, and Niu Jian, sign a document that will haunt their nation for the next century, the Treaty of Nanking. 13 articles that aren't negotiated. They're dictated. 21 million silver dollars in reparations. The island of Hong Kong surrendered for what the British promise will be temporary, but what becomes 150 years. 5 port cities forced open to foreign merchants and British gunboats. This isn't diplomacy. This is a ransom note written by an empire that just won a war, fought to protect opium smugglers. The math of the treaty tells you everything you need to know about power. $6 million for the opium that Chinese officials confiscated and destroyed. Opium that was poisoning their population, creating millions of addicts, draining China's silver reserves. The British Empire demands payment for confiscated contraband. $3 million for debts that Canton merchants supposedly owe to British traders. $12 million for the cost of the war itself. China must pay Britain for the privilege of being invaded. The interest rate on delayed payments, 5% annually. The British aren't just extracting wealth, they're establishing a principle. Might makes right, and the mighty get paid. This moment marks the beginning of what the Chinese call their Century of Humiliation. Over the next 100 years, foreign powers will carve up China like butchers dividing meat. The British take Hong Kong. The French take Indochina. The Russians take Manchuria. The Japanese take Korea and Taiwan. Everyone extracts concessions, ports, mining rights, railroad contracts. China's sovereignty becomes a legal fiction. The Qing government collects taxes to pay foreign debts. Chinese courts lose jurisdiction over foreign nationals on Chinese soil. It's colonialism without the bother of formal annexation. Fast forward 183 years. November 2025. China holds $683 billion in United States Treasury bonds. This number has fallen from a peak of $1.32 trillion in November 2013. But even reduced, it represents something extraordinary. The nation that was forced to pay silver reparations at gunpoint now holds hundreds of billions in claims on American government revenue. The country that foreign powers bankrupted through imposed indemnities now functions as one of America's primary creditors. The humiliated has become the banker. The empire has become the borrower. The irony isn't just poetic. It's structural, and it happened not through military revenge or revolutionary overthrow, but through something far more subtle. A patient understanding of how financial systems actually work, combined with a willingness to play a long game that Western governments, addicted to quarterly earnings and election cycles, couldn't match. This isn't a story about good guys and bad guys. There are no heroes here. This is a story about systems, how they're built, how they evolve, how power flows through them like water finding new channels when old ones get blocked. And right now, those channels are shifting in ways that would have seemed impossible in 1971, improbable in 1991, unlikely even in 2001. But by 2013, China held more American debt than any nation in history. Then they started selling, not dumping, not threatening, just steadily, month after month, reducing their exposure to the dollar system that has dominated global finance for over 50 years. Most people don't see this reversal because it's happening in the least dramatic way possible. Through central bank balance sheets, currency swap agreements, trade settlement mechanisms, boring technical stuff that financial journalists struggle to make interesting. But boring systems remake the world more permanently than wars. The Treaty of Nanking was dramatic. Gunboats, ultimatums, the humiliation of signing under duress. The reversal is statistical. Monthly Treasury holdings reports, basis point movements in interest rates, gradual shifts in reserve currency allocation. The question isn't whether the tables have turned. The question is how it happened. How does a nation go from paying silver reparations to holding the debt of the most powerful empire in human history? The answer doesn't begin in Beijing. It begins in Washington in August 1971, with an American president making a decision that seemed brilliant at the time, but contained within it the seeds of this exact reversal. To understand what China did, you first have to understand what America built, and then broke, and then tried to hold together with an increasingly desperate financial architecture that only looks stable if you don't examine it too closely. The story starts with gold, and the moment America decided it didn't need gold anymore. Before August 15, 1971, the global financial system operated under a set of rules established at the Mount Washington Hotel in Bretton Woods, New Hampshire, in July 1944. 730 delegates from 44 allied nations gathered while World War II still raged in Europe and the Pacific. Their task: design a monetary system that would prevent the competitive devaluations and beggar-thy-neighbor policies that had turned the Great Depression into a global catastrophe. What they created was elegant in its simplicity and contained within it the seeds of its own destruction. The Bretton Woods Agreement established the US dollar as the world's reserve currency. Every major currency would be pegged to the dollar at a fixed exchange rate. The dollar itself would be pegged to gold at $35 per ounce. Any foreign government could exchange its dollars for gold at the Federal Reserve. For every $35 in circulation, the United States guaranteed it held 1 ounce of gold in reserve. This gave the dollar credibility backed by something tangible. The system worked beautifully in its early years. The United States emerged from World War II holding roughly 70% of the world's monetary gold. American factories were intact, while Europe and Asia rebuilt from rubble. The dollar was genuinely as good as gold because America had both the gold and the productive capacity to back it. Foreign governments accumulated dollars through trade and used them as reserves. The dollar became the currency of international commerce, oil transactions, and the commodity pricing. It was a privilege that allowed the United States to run modest trade deficits without the immediate consequences that would cripple other nations. But privileges get abused, and the abuse began in the 1960s. The Vietnam War was expensive. By 1968, the United States was spending roughly $70 billion per year on military operations in Southeast Asia. President Lyndon Johnson's Great Society programs added domestic expenditures, Medicare, Medicaid, federal education funding, urban development initiatives. The government was running deficits, spending money it didn't collect in taxes. To cover these deficits, it did what governments throughout history have done. It printed more currency. The money supply expanded. The number of dollars in circulation grew faster than the gold reserves that supposedly backed them. Other countries started noticing. They did the math. They realized that if every foreign holder of dollars simultaneously demanded gold at the promised rate of $35 per ounce, the United States couldn't possibly honor all the claims. There simply wasn't enough gold. The ratio of dollars to gold was becoming increasingly divorced from the 35-to-1 promise. By 1971, the United States held about 8,000 tons of gold, worth roughly $12 billion at the official price. while foreign governments and central banks held claims on American gold that exceeded $60 billion. The arithmetic was unsustainable. France was the first to call the bluff. President Charles de Gaulle didn't trust American monetary promises. He saw the Bretton Woods system for what it had become, a mechanism that allowed the United States to export its inflation to the rest of the world. America could print dollars to pay for wars and social programs, while other nations had to maintain fiscal discipline or watch their currencies collapse. De Gaulle called it an exorbitant privilege. He was right, and he decided to test whether the privilege was real or illusory. In 1965, France began converting its dollar reserves into gold. French naval vessels sailed to New York Harbor. They loaded American gold into their holds and shipped it back to Paris. Other countries watched this carefully. If France could do it, so could they. West Germany started converting dollars to gold. Switzerland followed. The line was forming. The bank run was beginning. And America's gold reserves were draining at an alarming rate. From 1958 to 1968, U.S. gold reserves fell from over 20,000 tons to about 10,000 tons. The outflow was accelerating. By the summer of 1971, the situation had become critical. Foreign claims on American gold exceeded actual reserves by a factor of 5 or 6 to 1. The mathematics of Bretton Woods had broken down completely. The United States faced a choice: admit that the dollar wasn't actually backed by gold anymore, or keep pretending until the gold ran out entirely and the system collapsed in chaos. President Richard Nixon chose the former. What happened next would reshape global finance more profoundly than any treaty signed at gunpoint, including the one aboard HMS Cornwallis in 1842. The world was about to discover what money really is when you remove the last physical constraint on its creation. August 15, 1971. A Sunday evening. President Richard Nixon interrupts television programming with an announcement that will fundamentally alter money itself. He announces the United States is temporarily suspending dollar convertibility into gold. The word temporarily is fiction. The suspension will never be lifted. Nixon is abandoning the Bretton Woods Agreement. The dollar's link to gold is being severed permanently. Most Americans don't understand what this means. Financial markets are closed for the weekend, but in central banks worldwide, officials understand immediately. The United States has changed the rules because it was losing under the old ones. What emerges from the wreckage is something unprecedented in human history: a global reserve currency backed by nothing tangible. The dollar is no longer a claim check on gold. It's not backed by silver or land or any physical commodity. It's backed purely by faith. Faith in the United States government's ability and willingness to honor its obligations. Faith in the size and productivity of the American economy. Faith in the U.S. military's capacity to project power globally. And perhaps most importantly, faith in the absence of any viable alternative. No other nation has an economy large enough, markets deep enough, or military powerful enough to offer a competing reserve currency. The dollar wins by default, not by design. The immediate consequences are exactly what economic theory predicts. Inflation accelerates. When money isn't constrained by a physical anchor like gold, governments face perpetual temptation to print more of it. More money chasing the same amount of goods means rising prices. Throughout the 1970s, inflation becomes a chronic problem. Oil shocks make it worse, but the underlying cause is the money supply expanding faster than the productive economy. The dollar loses roughly half its purchasing power between 1971 and 1980. What cost $1 in 1971 costs $2 by 1980. But something else happens too, something that will prove far more consequential than 1970s inflation. The United States discovers it can fund government operations through a mechanism no other nation enjoys. It can print its own money to buy its own debt. The process is called monetizing the debt, and it works like an elaborate shell game designed to obscure the fact that it's really just a printing press with extra steps. Here's the mechanism. When the U.S. government spends more than it collects in taxes, which it has done in almost every year since 1970, it needs to borrow money to cover the difference. It does this by issuing Treasury bonds. These bonds are I owe us. They promise to pay back the principal plus interest at some specified date in the future. Someone has to buy these bonds for the government to get the cash it needs today. In theory, buyers should be private investors, pension funds, foreign governments, entities with actual savings to invest, and many Treasury bonds are bought this way. But there's another buyer, one with infinite purchasing power, the Federal Reserve. The Fed is technically independent from the government, but it's a distinction that matters more in theory than practice. The Fed can create money digitally with a few keystrokes. It uses this created money to purchase Treasury bonds from the government or from primary dealers. The government gets cash to spend. The money supply increases. The debt remains on the books, but it's now owed to an institution that can never go bankrupt because it can create infinite money. This is the printing press, disguised in the technical language of monetary policy. Open market operations, quantitative easing, asset purchases. The terminology makes it sound sophisticated and necessary, but the underlying reality is simple. The government writes itself an IOU, and the central bank creates money to buy that IOU. The government spends the money. The debt accumulates. And because the dollar is the global reserve currency, the rest of the world absorbs the inflation that would normally destroy a currency. This is the exorbitant privilege that de Gaulle warned about, now stripped of even the pretense of gold backing. The United States can run deficits that would bankrupt other nations because the world needs dollars to function. International trade is conducted in dollars. Oil is priced in dollars. Commodities are priced in dollars. Central banks hold reserves in dollars. The currency is woven into the fabric of global commerce so deeply that even as America prints more of it, demand remains. Any other nation that tried this would watch its currency collapse within months. When Argentina prints money to fund government spending, the peso becomes worthless. When Zimbabwe did it, their currency experienced hyperinflation so severe that they eventually abandoned it entirely. But the United States can do it year after year, decade after decade, because the dollar isn't just America's currency, it's the world's currency. And that means there's always someone willing to accept dollars, even as their value slowly erodes. This mechanism, this ability to export inflation and import goods while paying with printed currency, is what allows the United States to maintain global military presence, fund social programs, run persistent trade deficits, and accumulate debt that would crush any other nation. It's a privilege so extraordinary that it warps the entire global economy around it, and China was about to figure out how to exploit it. In 1978, 2 years after Mao Zedong's death, Deng Xiaoping consolidates power and announces reforms that will transform China from an impoverished agricultural society into the world's manufacturing superpower. His approach is pragmatic to the point of heresy for a communist state. It doesn't matter whether a cat is black or white as long as it catches mice. The mice he wants to catch are foreign investment, technology transfer, and access to Western consumer markets. Ideology is negotiable. Results are not. The strategy is straightforward. Open special economic zones, where foreign companies can build factories with tax incentives and relaxed regulations. Provide an endless supply of cheap labor. Hundreds of millions of workers migrating from rural provinces to coastal manufacturing centers, willing to work for wages that Western workers would never accept. Can build infrastructure at a pace that makes Western democracies look paralyzed by comparison. And most importantly, keep the currency artificially weak to ensure Chinese goods remain price competitive in foreign markets. This last part, the currency peg, is the mechanism that will eventually make China one of America's largest creditors. To understand how, you need to understand the basic mechanics of what happens when a Chinese factory sells products to an American company. A Chinese factory manufactures shirts. An American retailer orders 10 million shirts at $2 each, paying $20 million. The Chinese factory exchanges those dollars for renminbi with a commercial bank, which must sell them to the People's Bank of China. Chinese law requires it. The PBOC accumulates the dollars. Now the PBOC has $20 million. Chika multiply this transaction by every Chinese export: toys, electronics, steel, machinery, furniture, textiles, and the dollars accumulate at staggering rates. By the 1990s, China is running massive trade surpluses with the United States. More goods flow from China to America than flow back, which means more dollars flow into China than renminbi flow out. The PBOC's dollar reserves grow exponentially. By 2000, China holds approximately $100 billion in foreign reserves. By 2006, it's $1 trillion. By 2013, it peaks at nearly $4 trillion. But here's the critical question. What do you do with trillions of dollars that flood into your central bank every year? You can't just hold cash. Cash sitting in a vault loses value to inflation. The dollars need to be invested somewhere. They need to earn a return, or at minimum, preserve their value. And there's really only one place in the world with markets deep enough and liquid enough to absorb trillions of dollars in investment. United States Treasury bonds. Treasury bonds are the safest dollar-denominated investment on Earth. They're backed by the full faith and credit of the U.S. government, which, as established in Section 3, can print infinite dollars if necessary to pay its debts. They're liquid. You can sell billions of dollars worth in minutes without moving the market much. They pay interest, not high interest, but something. And crucially, there's no realistic alternative. European bond markets aren't deep enough. Japanese government bonds pay even less. Emerging market debt is too risky for reserves that need to be available on short notice. So China buys U.S. treasuries, not because they love America or trust the dollar's long-term stability. They buy them because they have no better option for parking the dollar reserves that accumulate from their export surplus. It's not a choice driven by sentiment. It's a choice driven by the mathematical reality of having more dollars than you know what to do with. But this creates something more sophisticated than simple creditor-debtor relationship. It creates a self-reinforcing feedback loop that benefits both nations in the short term while building up tremendous instability in the long term. The loop works like this. Chinese factories manufacture goods using cheap labor. They export these goods to the United States. American consumers buy them with dollars, including dollars that the U.S. government has printed or borrowed into existence. China receives those dollars, exchanges them for renminbi at the PBOC, keeping the renminbi artificially weak. The PBOC uses those dollars to buy U.S. Treasury bonds. This Treasury bond buying keeps U.S. interest rates low because there's always a buyer for government debt. Low interest rates allow Americans to borrow more money to buy more Chinese goods, and the cycle amplifies. China benefits because the currency peg keeps its exports competitive. The United States benefits because cheap Chinese goods keep inflation low while allowing the government to borrow at low interest rates. Both nations become dependent on the arrangement continuing. China needs the U.S. market to absorb its production. The U.S. needs China to finance its deficit spending. It's mutual dependency disguised as mutual benefit. The accumulation accelerates through the 2000s. After China joins the World Trade Organization in 2001, its exports to the United States explode. American manufacturing jobs disappear by the millions as production moves to China. But American consumers get cheaper goods. Walmart becomes the symbol of this exchange. Low prices made possible by Chinese manufacturing, financed ultimately by Chinese purchases of U.S. debt that allow Americans to maintain spending beyond their incomes. By November 2013, China holds $1,317 billion in U.S. Treasury securities. It's the single largest foreign holder of American government debt in history. The nation that was forced to pay 21 million silver dollars in 1842 now holds claims on American productivity worth 62,000 times that amount. Sure, the mathematical reversal is complete. But China's strategists understand something that American policymakers are slower to grasp. This accumulation of dollar reserves isn't strength, it's vulnerability. Every dollar China holds is a claim denominated in a currency that the United States can devalue at will simply by printing more of it. Every Treasury bond is a bet that the U.S. government will honor its debts in currency that maintains its purchasing power. And every month that China accumulates more dollar reserves is a month that it becomes more dependent on American financial decisions. The accumulation had served a purpose. It allowed China to industrialize, to move hundreds of millions of people out of poverty, to build infrastructure and technological capacity at unprecedented speed. But by 2013, Chinese leadership begins to recognize that the strategy has gone far enough. Perhaps too far. The peak has been reached. What comes next is the slow, careful process of reducing exposure to a system that China helped build but doesn't control. The unwinding begins, not with announcements or threats, just quiet, steady selling. Month after month, the Treasury holdings tick downward, from 1.3 trillion toward 1 trillion, then below it. The reversal of the reversal is underway. By 2013, both nations are locked in a financial embrace that neither can easily escape without inflicting pain on themselves. China holds over $1 trillion in claims on U.S. government revenue. The United States owes China more than it owes any other foreign nation. But this isn't the simple creditor-debtor relationship it appears to be on the surface. It's a mutual hostage situation dressed up as international finance. Consider what happens if China dumps its Treasury holdings rapidly. Flooding the market with hundreds of billions in bonds would drive prices down and interest rates up. U.S. borrowing becomes expensive. The economy could tip into recession. But China hurts itself too. Treasury values crash. The remaining bonds China holds lose tremendous value. A U.S. recession reduces American demand for Chinese goods. Exports fall. Workers get laid off. Social stability suffers. This is the trap. Neither side can fully weaponize its leverage without suffering severe consequences. It's financial mutually assured destruction. A Cold War logic transplanted into the realm of Treasury markets and trade flows. The stability of the arrangement depends on both sides understanding that escalation hurts everyone. But stability built on mutual dependency is fragile. And starting in 2013, China begins the slow process of reducing its exposure. Not dumping, not threatening, just steady, methodical selling. From the November 2013 peak of $1.32 trillion, the holdings decline. By April 2022, they drop below $1 trillion for the first time in over a decade. By December 2024, they're down to $759 billion. By November 2025, $683 billion. Almost exactly half of the peak, shed over 12 years through patient, careful unwinding. The question is why? What changed between 2013 and 2014 to make China reverse a strategy that had worked for 2 decades? Multiple factors converge. First, China's trade surplus with the United States begins to moderate. The flood of dollars entering China slows. Fewer incoming dollars mean less need to recycle them into Treasury purchases. Second, China's economy is maturing. The model that worked for catching up, export everything, save everything, accumulate foreign reserves, no longer makes sense for a middle-income country trying to transition toward domestic consumption. Chinese leadership wants its citizens to spend more and save less. That requires different policies. Third, and perhaps most important, the geopolitical relationship between the United States and China deteriorates. Trade tensions escalate. Technology restrictions tighten. Strategic competition intensifies. And then in 2022, something happens that sends a signal to every country holding dollar reserves. The United States freezes Russian central bank reserves after the invasion of Ukraine. Roughly $300 billion in Russian foreign exchange reserves, held in dollars and euros, become inaccessible. The West cuts Russia off from the SWIFT payment system. The message is clear. Dollar reserves aren't just an investment. They're a geopolitical tool. And if you cross certain lines, that tool can be turned against you. China watches this carefully. So does every other nation with significant dollar reserves. The calculation changes. Yes, Treasury bonds are safe in the financial sense. The U.S. government will always make payments. But are they safe in the geopolitical sense? Can they be frozen or seized if the relationship between Washington and Beijing deteriorates further? The question doesn't need a definitive answer to change behavior. The mere possibility is enough to make diversification rational. So China diversifies. Gold purchases accelerate. China increases official gold reserves for 11 consecutive months. Purchases of other currencies increase. Euros, yen, emerging market currencies. Belt and road infrastructure investments absorb dollars building ports and railways across Asia, Africa, and Latin America. Chinese companies acquire foreign assets, mines, energy projects, technology firms. The diversification isn't just China. Look at the broader pattern. Total foreign holdings of U.S. Treasuries peaked in 2021 at roughly $8.7 trillion. By December 2024, they've declined to $8.5 trillion. Japan, the largest foreign holder, reduces its positions. The United Kingdom, the second largest, fluctuates but shows no sustained growth. Even smaller holders are diversifying away from dollar concentration. The trend is global. The number that matters isn't China's $683 billion. It's the directionality. Every month, China sells more. Every month, the position shrinks. And there's no indication the trend is reversing. This isn't a temporary adjustment. It's a strategic repositioning that will continue for years, possibly decades, until China's dollar exposure reaches whatever level Beijing has determined, is optimal. And that level is clearly much lower than 1.3 trillion. The unwinding is happening in slow motion, which is the only way it can happen without triggering crisis. But slow motion doesn't mean insignificant. Slow motion just means you need to watch over a longer time frame to see the full shift. And the shift is unmistakable. The nation that financed America's deficits for 2 decades is steadily withdrawing from that role. Not all at once. Not with announcements. Just month by month, billion by billion, finding other places to park its wealth, building other systems to move money, reducing the hooks that the dollar system has embedded in its economy. The question isn't whether China will continue selling. The question is what happens when the selling is complete. China's Treasury sales would be noteworthy on their own, but they're not happening in isolation. Marilo, what looks like a Chinese strategic decision is actually part of a broader pattern, a slow, global recalibration of how nations think about reserves, currencies, and financial sovereignty. The dollar system that emerged from the Nixon Shock of 1971 and solidified through the 1980s and 1990s is experiencing something it hasn't faced since its inception: coordinated, deliberate diversification by the rest of the world. The numbers tell the story. In 2000, the dollar accounted for roughly 71% of global foreign exchange reserves. By 2010, that had declined to about 62%. By 2020, 59%. By the end of 2024, it's closer to 58%. These look like small shifts. A percentage point here, 2 percentage points there. But we're talking about the global reserve currency, the foundation of international finance. A 1% shift represents hundreds of billions of dollars redirected into other assets, other currencies, other systems, and the trend shows no sign of reversing. Japan, which holds roughly $1.2 trillion in U.S. treasuries, has been reducing exposure. The United Kingdom fluctuates, but shows no sustained increase. Smaller holders, Saudi Arabia, Switzerland, Belgium, show similar patterns. The era of endlessly growing foreign appetite for U.S. government debt is ending. Part of this is simple arithmetic. The U.S. government's debt has exploded. In 2000, total public debt was roughly $5.7 trillion. By 2008, it was $10 trillion. By 2020, $27 trillion. By 2025, it's approaching $38 trillion. At some point, foreign holders look at these numbers and ask a rational question. How does this end? How does a nation service debt approaching $40 trillion? The interest payments alone are becoming unsustainable. In fiscal year 2024, the U.S. government paid approximately $880 billion in interest on the debt. That's more than the defense budget. It's more than Medicare. It exceeds spending on veterans, education, and transportation combined. And the debt keeps growing. But the diversification isn't just about fiscal concerns. It's about power and sovereignty. The 2022 freezing of Russian reserves was a watershed moment. For decades, the implicit bargain was this: hold your reserves in dollars or dollar-denominated assets, and those reserves are safe, liquid, available whenever you need them. The U.S. might use economic sanctions, might restrict trade, might impose tariffs, but the reserves themselves were sacrosanct. They were property, protected by the same rules that protect any property. The Russia sanctions changed that calculus. $300 billion in Russian central bank reserves, money that Russia had earned through oil and gas sales, saved rather than spent, invested in what were supposed to be the safest assets in the world, suddenly became inaccessible. The justification was clear. Russia invaded a sovereign nation, but the mechanism was what mattered. The West demonstrated that dollar reserves, euro reserves, any reserves held in Western financial systems could be frozen for geopolitical reasons. Every finance ministry in every country not fully aligned with Washington watched this and recalculated risk. China certainly did. But so did India, Turkey, Brazil, Saudi Arabia, the United Arab Emirates, Indonesia, Malaysia. Nations that aren't adversaries of the United States, but also aren't willing to subordinate their foreign policy entirely to Washington's preferences. The question they all asked, if this can happen to Russia, could it happen to us? And if the answer is anything other than absolutely not, then diversification becomes rational risk management. This thinking drives the expansion of alternative systems. The BRICS coalition, originally Brazil, Russia, India, China, South Africa, has expanded to include Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. These nations represent roughly 45% of global population and about 36% of global GDP. They're not united by ideology. They're not a formal alliance, but they share an interest in reducing dependence on dollar-denominated systems. They're discussing alternative payment mechanisms, potential reserve currencies, bilateral trade settlements in local currencies rather than dollars. China and Russia have been settling bilateral trade in renminbi and rubles for years. India buys Russian oil and pays in rupees. Saudi Arabia, which for 50 years sold oil exclusively in dollars under an arrangement that made the petrodollar central to global finance, now accepts payment in yuan for oil sales to China. The monopoly is breaking. The arrangement that made every nation accumulate dollars to buy oil, thus creating automatic demand for dollars and treasuries, is eroding. Digital currencies accelerate this trend. China has rolled out the digital yuan in pilot programs across major cities. The European Central Bank is developing a digital euro. These aren't cryptocurrencies. They're central bank digital currencies, sovereign money, but digital, programmable, capable of settling international transactions without correspondent banks, without SWIFT, without the dollar as an intermediary. The infrastructure for non-dollar international settlement is being built piece by piece. None of these alternatives are ready to replace the dollar. The euro is hampered by European political fragmentation. The yuan isn't fully convertible, and China maintains capital controls. No single currency has the combination of market depth, legal predictability, and global trust that the dollar offers. But that might be missing the point. The future might not be dollar replacement. It might be dollar marginalization. A world where the dollar is still important, but no longer dominant. Where it accounts for 40% of reserves instead of 60%. Where half of oil transactions settle in other currencies. Where major economies have the infrastructure to bypass dollar systems when convenient. That world doesn't require replacing the dollar. It just requires reducing dependence on it, and that process is already underway. China selling treasuries is the most visible part of a much larger reconfiguration. The pieces are being moved quietly. The infrastructure is being built without fanfare. The alternatives are being developed one digital wallet, one bilateral agreement, one reserve diversification at a time. The United States still holds enormous advantages. The dollar is woven into global finance in ways that will take decades to fully unwind. American capital markets are the deepest and most liquid in the world. The U.S. military can project power globally in ways no other nation can match. These advantages don't disappear overnight, but advantages aren't permanent. The British pound was the world's reserve currency for over a century, until it wasn't. The transition from pound to dollar took roughly 30 years, from 1914 to 1944, driven by 2 world wars and a depression. The transition from dollar dominance to something else might take a similar time frame. We might be 15 years into that transition already, which means we're not watching the end of dollar hegemony. We're watching the beginning of the end. And the thing about the beginning of the end is that it looks remarkably stable right up until it doesn't. This isn't just about Treasury bonds and central bank reserves. What we're watching is a deeper question about how power works in the 21st century and whether the models that dominated the 20th century still function. The Treaty of Nanking in 1842 represented one answer. Power flows from the barrel of a gun. Wealth is extracted through military force. Empires are built on the ability to project violence. That model worked for a century. Then it stopped working. The Bretton Woods system and its successor, the post-1971 dollar order, represented a different answer. Power flows through financial architecture. Wealth is extracted through currency manipulation and debt accumulation. New empires are built on the control of money itself. This model has worked for 50 years. The question is whether it's stopping. What China has demonstrated isn't military strength. It's strategic patience, the ability to play a game across decades rather than election cycles, to accept short-term costs for long-term positioning. Chinese workers were paid artificially low wages for 30 years because the currency peg kept the renminbi weak. That's a generation of suppressed consumption, of deferred gratification, of building productive capacity while accumulating claims on foreign productivity. Western democracies struggle to make sacrifices that pay off in 4 years. China executed a strategy that took 40 years to reach fruition. The United States, meanwhile, has been playing a different game. Maximize consumption today. Finance it with debt. Trust that the dollar's reserve status will allow the borrowing to continue indefinitely. This works brilliantly until it doesn't. The question is when the doesn't arrives. The arithmetic is unforgiving. The U.S. national debt is $38 trillion and growing. Interest payments are $880 billion annually and rising as old debt at low rates matures and gets refinanced at higher rates. The deficit for fiscal year 2024 was approximately $1.8 trillion. At current trajectories, the debt will exceed $50 trillion by 2030. How does this end? There are only 4 mathematical possibilities. First, default. Simply refuse to pay. This would destroy the dollar as a reserve currency overnight, collapse global financial markets, and end American economic dominance immediately, when it's theoretically possible but practically unthinkable. Second, austerity. Cut spending or raise taxes dramatically to balance the budget and begin paying down debt. This is politically impossible in a democracy where both parties promise more spending to different constituencies. Third, inflation. Print enough money to make the debt smaller in real terms. This slowly destroys the currency's purchasing power and eventually undermines its reserve status. Fourth, growth. Expand the economy fast enough that GDP grows faster than debt, making the burden manageable through productivity gains. This requires technological breakthroughs or policy changes that seem unlikely given current trends. The United States will probably try some combination of options 3 and 4, moderate inflation plus moderate growth, while hoping the problem becomes manageable. But moderate inflation over decades adds up, and growth isn't guaranteed. especially as demographic decline, productivity stagnation, and political dysfunction create headwinds. China, watching this, is making a different bet. They're betting that the dollar system is in its final decades of dominance, not its final years. There's no imminent collapse, no crisis moment on the horizon. But the long arc is bending away from dollar hegemony and toward something else. What that something else looks like isn't clear yet. Maybe a multipolar reserve system with several currencies sharing the role. Maybe a Chinese-led alternative that gradually absorbs much of Asia, Africa, and Latin America. Maybe something that hasn't been invented yet. What is clear is that the mechanisms that allowed the reversal from 1842 to 2025, from China paying silver reparations to China holding American debt, are still operating. Systems evolve. Power flows through new channels. Patient players who understand the architecture can exploit it in ways that seem impossible until they're already accomplished. In November 2025, China holds $683 billion in U.S. Treasury bonds. That number will be lower in November 2026, and lower still in November 2027. Not crashing, not dumping, just steadily, methodically, irreversibly declining. Month by month, the nation that was humiliated in 1842 is unwinding its exposure to the nation that dominated global finance since 1971. The Treaty of Nanking was signed at gunpoint aboard a British warship. The reversal is happening in spreadsheets, central bank balance sheets, and monetary policy committees. Different mechanisms, same historical arc. The humiliated becoming the creditor, the empire becoming the debtor, and now the creditor deciding they'd rather be neither. What comes after that decision is fully executed is the question that will define the remainder of this century. And the answer is being written right now, in transactions that don't make headlines, by institutions that operate in the shadows, through processes that won't be fully visible until they're already irreversible. The moment America lost control wasn't a single moment. It was thousands of moments, stretched across decades, each one moving the system incrementally toward a new equilibrium. We're still in those moments. The transition isn't complete, but the direction is no longer in doubt.